Hello everybody, the Teenage Investor here. Today we're talking about how to buy stocks. So recently on my channel, I've been talking about the stock market and how to make money in the stock market. But before making money in the stock market, you actually have to know how to buy stocks. So today I'll be telling you how to buy stocks in 6 simple steps that you can follow, and you can have a stock brokerage account of your own, and you can start investing your money into publicly traded companies. Now, number one, you're gonna have to open a brokerage account. So there's many different brokerages all across the world, but today I'll be telling you a few of the most popular ones throughout USA, the international side, and Canada. So for USA/international, you have E-Trade and TD Ameritrade. So those are the two most popular ones in the US that are based in the United States, but are most commonly used by international users as well. And then you have Canada brokerages that are Desjardins Online Brokerage and TD Direct Investing. So those are the two most popular ones for each. But obviously there are all kinds of brokerages, and you're just gonna have to do some research for yourself on which ones exactly are for you. Now, number two, you're gonna have to deposit some money into the account. So you have to be aware that some brokerages have a minimum first deposit. What that means is that you can't actually open the actual account unless you have a minimum balance of whatever their balance is. So it can be $500 or it can be even $1,000. So number three, you're gonna have to find a few stocks that you are interested in and understand completely. So basically, how you do that is you're gonna want to look around your house on products you use every single day, and you want to see the companies that manufacture those products. So let's say you use an iPhone on a daily basis, you're going to want to look at Apple if you understand how that business works and how they make their revenue, and how they will be able to grow their revenue in the future. And you have to understand their competitors and also their space that they're working in and how it's going to be looking in the either short or long term, depending on what kind of investor you are. So number four, you're gonna have to do your research on those few companies. So you're gonna have to look at the financials, and you're gonna have to look at all their financial reports, and don't look at a stock price and graph for a while until you read reports and understand the business. So before I look at any price of any stock or any graph, I just look at the business. I look at their financials, I look at their reports, I look at how they will be doing in the future, and I'll look at how they can grow revenues, how their industry is looking in the next 5 years. Since I'm a long-term trader, I look at how will their space evolve throughout the next 5-10 years. Now, after that, you can obviously look at the stock price. You're going to see how much you actually want to spend for that actual stock. But after that, you're going to have to choose the first stock that you are most confident in, and you're going to have to invest part of your deposit in that stock. Now, obviously, you don't want to choose a stock that you're not the most confident in. Like, it has potential, but you're not sure how it will do or how the industry will be, or there's going to be some challenges, or you're going to want to choose the first stock that you're most confident in. So let's say you have Apple, and you know for sure that within the next 5 years, they will grow revenue by 25%. Well, then obviously you're going to want to look into Apple and start off investing in Apple instead of looking at a company like maybe a small penny stock and being very skeptical about it. And obviously, I never recommend any of my friends to buy penny stocks, because penny stocks are the most risky thing you can do with your money. And now, number six, and finally, the last step is you're gonna have to wait and watch your stock over the predetermined period for the investment. So before you make any type of investment, you're gonna want to choose a period of time you're looking for that investment. So let's say I'm looking into Apple. I could choose many different time periods to invest in Apple. So I can choose to invest in it for the short term, for the long term, or even as a day trader, I can choose to trade it during the day. But you're gonna have to stick to that predetermined period. So let's say I'm looking at Apple today, and I think that within the next 5 years, they're gonna grow revenue by 10% per year. Well, I'm gonna say that I want to keep Apple until they reach their maximum potential after 5 years. Now, I don't really care if the stock goes up 10% tomorrow, 20% tomorrow, because within those next 5 years, I'll be making much more than 10% as a return. Plus, if you keep a stock for under a year, you'll have a lot of taxes to pay. You're gonna have to pay your normal tax bracket of your salary, whereas if you keep it for more than a year, the tax bracket decreases to 15 or 20% depending on where you live. And that's pretty much it for the period aspect of it. But now, most importantly, you don't let your first few investments get to your head. So when you start investing, you're gonna have some good investments, some bad investments. You're gonna have to continue investing with your main investing principles in mind. Don't listen to others, and always trust your gut instinct. So basically, let's say you made your first investment, right? And you made 25% return on that investment. And you make another investment, you make 35% on that investment. Don't think that you're the next Warren Buffett. So I always hear stories about some people that invest some of their money and then they get a 25% return on that money, and then they say, you know what? Wow, I'm a really, really good trader. No, you're not. You just got lucky. Now, you may be good at investing, but you're gonna have to do many, many more investments before you actually know that for sure. Now, when I say don't listen to others, obviously you're gonna want to listen to the news, listen to what's happening with that company, but don't take everything they say as being truth. So basically, if someone says, okay, this company is overvalued, it's gonna go down, don't invest in it, don't invest, blah, 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 you're gonna have to listen to the wise words of Warren Buffett. Be greedy when others are fearful, and be fearful when others are greedy. What that pretty much means is that when everyone's going into the stock market thinking, wow, I'm going to make tons of money, you want to get out of there as fast as you can, because it's going to come crashing down. And when everyone's saying, no, don't invest there, you're going to lose all kinds of money, you're going to lose your house, you're going to lose your... No, you better get into that market, because if you see potential in that market, it's going to rise, and everyone's gonna miss out on the opportunity to make that much money. And that's exactly what happened in the stock market crash of 2008-2009, when nobody wanted to invest in that, and then a few smart people went in and started investing, and then they saw that the market started going up and up and up, and the other people started investing as well. And the people that got in 2008-2009 are the people that made the most money out of everyone. But that's pretty much it, guys. Thank you guys so much for watching. Hope you enjoyed the video. Don't forget to leave a like and subscribe down below. And until my next video, have a great day.